When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about 4 out-of-the-box retirement moves that the wealthy swear by. Also, fixed index annuities and bonds, strengthening your retirement portfolio. We'll answer lists of questions. And finally, LIRPs, the retirement solution or just one tool. My name is Jeff Shade. As always, I'm just here to ask the questions. But the words of wisdom and solid advice, they come from Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
Doing great, as always. Always fun to be with you and the listeners, and have a great show lined up, it sounds like.
I think we do, Jeff. And as always, I'm glad to be with you as well, too, and all the fine people here of the greater Tucson area. So let's start off, Jeff, by talking about 4 out-of-the-box retirement moves that wealthy people do swear by. Most of us, maxing out our 401ks is the key to a secure retirement, but you're saying that there are other moves that wealthy retirements use. Can you give us an overview of what those might be?
Many people are told or programmed to think that what gets you to retirement gets you through retirement. For example, 401ks are kind of the standard now, since pensions don't exist very often. It used to be companies would put away money for you and make sure you had an income during your lifetime so you didn't have to worry about stuff. And if you had any extra, you could save it. And if you didn't save it, you still had income. And that was kind of that safety net. Now, employers say, we don't know how long these people are going to live. We don't want to try to manage a portfolio and take away earnings opportunities for our stockholders and have to fund these huge pensions that kept growing and growing. So we know that over the last 20, 30 years, pensions are almost obsolete. Very few, just government, it seems like, give pensions anymore due to the fact that they can always just tax the heck out of us and pay for them. But companies can't do that. So they allow you to put away your own money, and then they'll supplement it with a little bit of their own, maybe a 3 or 5% match. And you grow this nice little retirement account. But what do you do? I mean, it's basically a defined contribution plan. They'll tell you how much you can put in, and they limit it. You can't even overfund it, unless you get some side businesses and play some funny IRS tricks. I mean, I do that, and a lot of my wealthier clients that have high income do that. And some people listening might be able to do that too if you own your own business. But if you don't, you're kind of limited to 401ks. And people get into their 401k and think, well, yeah, I've got $1 million. I've got $2 million. Wow, I've saved a bunch. That should last me a lifetime. Well, what about volatility? Those 401ks typically do not offer things like guaranteed income like a pension does. They don't offer things like annuities. They don't offer LIRPs, like the life insurance version of an annuity that gives you tax-free income. You might convert to a Roth, but if you convert to a Roth with 401k money, let's say you have a $2 million 401k, you put $1 million into a Roth, you have to pay taxes on that over the time that you convert it, or maybe you funded it over time. Bottom line is that income can come out tax-free. You paid taxes on what would have been $1 million in tax-deferred income. And what if the market crashes? Now you're pulling money out at a loss. You pay taxes on the higher amount. You're taking a loss, and that money doesn't grow tax-free anymore. You used it. You basically killed your golden egg. You ate your goose that lays the golden eggs. So volatility kills retirement plans. And 401ks, although they've tried to allow you to do some Roths and do some tax planning, they've never really answered for the annuity or the pension type plan. And I interchange annuity with pension because a pension is a guaranteed monthly or periodic income stream. So is an annuity. That's the definition of an annuity. Your Social Security is an annuity. So don't be afraid of the word annuity. Just be afraid of some annuities, because some annuities don't really perform like they were touted to. Some annuities are very fee heavy and they don't really make sense. I don't like variable annuities, for example. I hate to say that and kind of stereotype them, but I just really haven't met variable annuities that I like, that I can justify the fees and the layers of different aspects to them that make them inefficient. My opinion is you get a fixed annuity that has more guarantees and less fees, and you put the rest of your money or some of your money into a low fee or an efficient way to invest for the upside, and then you get the guaranteed income on a more fixed or guaranteed income type play. So diversifying beyond the 401k is probably the first rule of thumb. Is the 401k got you there, but believe me, there are so many more tools. There are so many more ways to build your financial house and make it secure, so that you can turn that 401k more into that pension of old that you don't end up getting. You can create your own pension. You can buy them through commercial insurance companies that will insure your income for life, regardless of how that particular account performs. In other words, if that account runs out of money, you still get your income till you die. You can even set it up for a joint income where you get a spouse that can also get that income even until they pass away, even if it's years after you do. So there's ways to structure some of your 401k into annuities. Now, unfortunately, I think it's fortunate for me because, we do those, but 401ks really have not risen to the occasion to move into that business. They really like the ongoing fees and to convince you to stay in it so they can continue to do a nickel and dime you till you die and just say, don't worry, hang in there, just take 4% of it out, you'll be fine. And you may or may not be fine. The fact is they can't guarantee it. I like guarantees. And one of the things that is available for those people that can't put an annuity in a 401k or diversify out of the 401ks is the fact that at age 59 and a half for most 401ks and some other qualified plans, 401As, 457Bs and stuff like that, 403Bs, some of those are not available at age 59 and a half. But generally speaking, 401ks can be accessed or transferred. You could actually do your own thing with some of your money, which is called an in-service withdrawal, meaning even if you're working, as soon as you hit that 59 and a half age, 401ks have been mandated to allow you to pull money out so that you can diversify and so that you can move that money away from the 401k and away from the risk that you're taking in stocks and bonds. And by the way, bonds do have risk. We just found that out in the last few years. The bond market is still down over the last few years compared to what it was in 2022 before the market started crashing and bonds started going down and Fed had to start raising interest rates, which killed the bond market. So that's still weak. Stock markets have had their good days and their bad days. We're at an all-time high, so we might be looking at another correction soon. We have to be worried about those things. So how do you take that risk off the table if you're 59 or 60 and you want to retire in 5 years? I mean, the last thing you want to do is have the market and even the bond market crash 20, 30, or 40, even 50% and have you say, oh gosh, now I have to work another 5 or 10 years till the market comes back so that I can retire on what I thought I was going to retire on 5, 6 years ago, or in a few years rather than a decade from now. Thankfully, the laws and the rules have changed to where you can access most people in reasonably large companies that have a reasonably normal 401k. Some small companies don't allow in-service withdrawals just because it's too hard to manage a small 401k like that. But most companies that people work for that have 401ks are able to access them at 59 and a half, and they should think about moving some of those profits. I mean, we're in good market times right now. You've probably done very well in your 401k. And part of you says, let's let this ride, man. It's doing great. Why would I get out now? Well, you get out now because you can lock in profits. You've done well. You can't get hurt when you lock in profits. In fact, if you can lock in profits and have a product that never goes down and only goes up when the market continues to go up, or if the market goes down, it won't go down, it will be able to offer you that lifetime income that you can't get from the stock market. So I think the first level of diversification is consider what you need in income above and beyond the Social Security that you're going to have. Look forward, project forward. Just if you're in your early 60s or even in your 50s, how much do you need to supplement your 401ks or other retirement plans with in order to create an income stream that you can count on? And if you're getting close to like in your 60s and you want to retire at Medicare age, for example, at 65, you've only got 5 years to wing it. Those 5 years might be those critical years where if a market crash happens, it could kill your retirement plan. If it continues to go up, great. But why not have the best of both worlds and diversify out of those risk assets into non-risk assets that guarantee the income you're going to need when you retire? So that's number one. That's the biggest one that we talk about when people come in is when you retire, what is your income need going to be? Is that income need just a what if and just to hope the market does okay so I can still have it? Or am I going to just hold and if the market goes bad, I just can't do anything fun. I have to just wait for it to come back and I have to hope I can live on Social Security alone. So bottom line is diversifying is, realize that there's things outside of 401ks that you can get into. Number two really is what I've already been talking about. And that's kind of what are we going to do for income rather than growth? Growth is great in a 401k. That's what you're supposed to do for the 30 or 40 years while you work. You're supposed to take every bit of matching funds that you can. You should look at your tax bracket. Some people don't, but you should look at your tax bracket and find out how much of your 401k you should be willing to pay taxes on now in order to convert it or to put it in a Roth version of 401k so that the money coming out will be tax-free. So now when you talk about income, you talk about diversifying outside of a 401k, which is all risk, into an investment that generates cash. We like annuities. We like fixed index annuities for income with income riders or income guarantees that you just can't get in the stock market. And Wall Street hates the idea that their reps want to sell insurance, but they don't let them because it's counter to their plan. In fact, that's what happened to me 30 years ago when I found retirees were struggling with the idea of managing risk, still wanting income, and I didn't have anything I could offer them. All I could offer them was risk. And so I graduated from that, limited platform, even though it was a bigger firm and names people would recognize. But I went out to a smaller independent company that believed in diversifying into those, not just the stock market and those things could continue to grow, but those things that would create income. And after a while, I learned about a version of that is tax-free, which I think tax-free income inside your 401k is important. One of the things I mentioned was the Roth 401k or even a Roth IRA. You do have to pay tax on that money up front, but you never have to pay tax again. By paying taxes now at a lower rate on a smaller amount of money is way better than paying at a higher rate on more money later. Now, if you pay at a lower rate later and levelize your income, it may, in fact, for some people, be smarter not to do a Roth conversion. And that's where a good financial advisor that knows how to do math and has a nice proprietary spreadsheet, which we call the Premier Retirement Roadmap, which includes an income plan that is not only tax efficient, but shows you income and also easily point out how much to convert to a Roth, how much to pay taxes on now rather than in the future, and how to make that overall income during your retirement lifetime the most tax efficient possible. One of the things that we like, in addition to Roth IRAs and annuities that produce tax-free income, and by the way, you can have a tax-free annuity. You can have an annuity that creates guaranteed income in a Roth, which creates tax-free income. It's a tax-free annuity. You can do that through Roth IRA conversions. So don't think that you're limited just because the guy that you've been doing your 401k with or the guy at your big box retail, a broker dealer, the name brands, the big banks, big brokers tell you, oh, you can't do that or we don't like those. Well, they don't like them because they're told they can't sell them or they told that their other models more lucrative, not just for the company, but also for those reps that supposedly represent you, but they don't. They represent the company. So again, convert it to tax-free retirement. I mentioned earlier that there's a thing called LIRP, life insurance retirement plans, that we can go into lengthy details about. And I think you mentioned earlier that we'll probably talk about that later today. The LIRP is a life insurance version of an annuity. The difference is it's not guaranteed, but it's pretty predictable. It gives you the features of an indexed annuity where the downside is eliminated in your cash account or your accumulation value in the life insurance version of this income annuity. And the upside is actually higher than most annuities are, because what the company, the way they make their money is basically just charging you for the cost of insurance or the cost of risk. In other words, if you have $500,000 into a LIRP and that's your cash value, and let's say you have $700,000 worth of death benefit, well, the insurance company knows that $500,000 of it's your money, so you have to pay for the insurance of the $200,000. So they're fine betting that you won't die and taking a couple $1,000 on that $200,000 every year. And that's their profit margin. That's how they pay their reps. Here's a cool thing, though. That $500,000 that's in your cash value continues to grow, not only tax deferred, it's tax free, and it compounds and continues to grow. But when you use that money, you don't actually pull it out of the account. You borrow against that future growth and you borrow against that future tax-free death benefit. So you get tax-free income, never shows up on a 1099, never pushes your taxable income or anything that shows up on your tax returns into a category that would show you having provisional income that would force your Social Security into a higher tax bracket. Your IRMA, the income with respect to your Medicare premium. So the IRMA doesn't go up with these. And the cool thing is the cash value doesn't draw down. So that cash value continues to compound, which is different than what a Roth would do. And in many cases, a 6% annualized rate of return, I'd say in most cases, really, when you do the math, a 6% annualized rate of return on a LIRP would create more tax-free income and a bigger death benefit than a 10% average annualized return that would correlate to the stock market returns. Because in a Roth, you're actually pulling the money out. You're never going to see that money again. It's not in your account anymore. However, on the LIRP, it continues to compound and you're borrowing against the growth. So different animals, but different ways to create tax-free income. So really the diversification out of your 401k is probably the biggest thing. And then how to invest that money into income-generating assets and do it tax efficiently.
Talking with Jeff Vogan of Premier Retirement here. We're talking about out-of-the-box retirement moves that the wealthy use. We've talked about diversifying beyond the 401k. Jeff, I want to talk about real estate. That is another one here. And I'm not talking about active real estate, but I'm talking about passive real estate.
Okay, so you're not really talking about rentals or short-term rentals. There are some things you can do if you feel like being a landlord in retirement or hiring a management company to do some short-term rentals. You can even change careers and become a real estate investment professional as long as you log your time and pretend that you're in the business, and you can use all kinds of fun tax programs and things like that. But if you want to be truly passive, as you said, and just invest. I mean, one of the things that I do is I find developers that want to sell homes, typically on the lower end of the scale where people may not be able to qualify for loans, but I can basically provide cash to loan or to build homes or to flip homes and things like that. I do that on an individual level just because my son is very integrated into that business. But there are private equity firms that have, and we're actually creating one at Premier, that actually have a pool of those kind of loans where you can invest and become the capital supplier and then get a return of better than 10% on those. They could be risky because there are default risk. You might have to private equity fund or private equity manager might have to repossess a property and sell it, and it might cause some hiccups. But that's why you probably don't want to do it on your own, just because it is kind of a job, and you might want to just consider that. But there are private equity things that are available, especially, and we have several private equity that typically they're $1 billion funds and they only want like 5 or 10 clients. So you have to have multi-million dollars, and typically it's institutions that play with these or super rich people, family banks and so forth. But just due to technology and just due to the fact that we work with a network that goes out and finds private equity groups that would allow us to be one of those multi-million dollars or $100 million client or even a $500 million client for them collectively between my firm and about 500 other independent firms, we pool our resources and we can get involved and actually create a ticker symbol or actually create a fund segregated from these real estate investment trusts and stuff. I hate to use that word. It's not really a real estate investment trust. It's more of a private equity investment firm. It doesn't always have to do with real estate. It could be just lending on products and manufacturing and different things. But we can participate in that by collecting a whole bunch of tiny deposits from a whole bunch of normal people clients. And then together we become a big enough client for some of these private equity firms to, entertain business with. So we have our own tickers at Fidelity that we can trade proprietary to just us and our clients that have a return of around that 10% level and pretty much hold the net asset value holds pretty stable. So that might be an option to enhance returns if you are an accredited investor. Typically $1 million in assets or a $250,000 income is what it takes to be an accredited investor. But there are some publicly traded REITs and things like that I don't typically like to use that are kind of alternative investments that are not stocks or bonds, but may provide more of a steady income that pays a higher dividend than, say, a 20-year bond at 3.5% that might go up or down, and a money market account that probably isn't even paying 2% anymore, or a CD paying 3 or 4. So there are ways to still have relatively safe money or at least secured investment money through independent firms like us, where you don't have to be a multi-billionaire or a family bank worth hundreds of millions of dollars in order to participate in some of these private equity type investments. So that would be one way to do like passive investments or real estate type things. I mean, I wouldn't say passive is going out and finding venture capital opportunities to swing for the fences unless you really have money to throw away and risk. But I think if there's a market for it, it's tradable. If you can get in and out reasonably easy, if it can be relatively liquid and give you a nice or provide a nice steady income where you might not need the liquidity, then I think these private equity and alternative investments are a good option to look into. And we have a slew of opportunities from names you've heard of and from names you haven't heard of. In fact, the names you haven't heard of typically pay better because the names you've heard of typically skim 3 or 4 levels of commissions and fees off the top before they pay you. But nevertheless, they still are doing things that you and I, as normal people, can't do on our own. So we go out and leverage what we have as far as a client base and access some of those investments that are only available typically to the super rich.
Jeff, another out-of-the-box retirement tool that people may use is an HSA as a stealth IRA. How does that work?
I like HSA. Some companies provide those, and you can do an HSA. You can't put into HSA if you're already retired and don't have income, unfortunately. You can't just move money in there. But if you're still working or getting ready for retirement and your company doesn't offer them, there are ways that you can open your own HSA and qualify as long as you have a certain high deductible insurance plan, which isn't too high deductible. There are some rules. And I have some clients that are still working for another few years. They're either self-employed or they work at a place that have an insurance policy. Maybe they're buying their insurance policy on their own. They can contribute to an HSA. It's kind of like an extra IRA. The contribution limits are similar. And the cool thing is you can put this money away and defer it forever. The cool thing is there's no mandatory withdrawals when you're 70 and a half. So you can put the money in there. It's tax deductible, and it's also tax deductible when you pull it out to pay for medical expenses. And my son is a CPA and he knows some cool tax strategies. And one of the things that he taught one of our clients was if you can afford to just pay for your insurance or get reimbursements from your company, or it's not a financial hardship to pay these out of pocket, pay them out of pocket. You can save your receipts, and there's no limit on when you can actually reimburse yourself for those medical expenses. So you can allow that HSA to compound tax-free, grow and grow and grow, take those receipts out, and then have all that compounding profit in that account. So in other words, you can save those receipts for when you need a big chunk to come out tax-free to go on a trip even, or to just do something else. But again, it does reimburse legitimate healthcare costs, you just don't have to charge the HSA exactly when you do it. But it's a stealth IRA where you never really have to pay taxes on it if you use it right. The other thing I like to defer that for is I really am not a proponent or a fan of this pay-as-you-go long-term care insurance where you pay premiums and pay premiums. They keep raising the rates, and pretty soon they raise them so high you can't even afford the premiums anymore. And then you turn 85 years old, you get sick or have a stroke, and you have to use the long-term care insurance, and you decided 5 years ago to drop it because they kept raising the rates and you thought you'd never have a claim. Well, they love that. But what about HSA? If you put just a few $1,000s in an HSA every year when you're in your 50s or 60s, by the time you're in your 80s or 90s, you might have hundreds of thousands of dollars in there that could be used to pay those costs, and compounding in an account that could pay for that long-term care final expenses. When you get really old, have those higher expenses, typically the older you get, the more medical costs, it seems, crop up. So that HSA, if left untapped, instead of putting money in just to take it out next year or to pay healthcare costs and think, well, I already prepaid my healthcare costs and at least I get it deducted that way. What if you compounded that to where your thousands of dollars ended up being tens of thousands of dollars or hundreds of thousands of dollars, and that money was still able to come out tax-free? Now, here's the worst case scenario. Worst case scenario is if you decide you don't need that or you never needed to use it for healthcare costs and you want to just cash it in. Well, then you do have to pay taxes on the gains. So what? It's just like an IRA. You never have to pay taxes during the rest of your life. So that's the worst case scenario in an HSA. I think the best cases are far better, and the options and the flexibility make it one of those things that you ought to add to your financial plan if you haven't already and if you're in a position to do so. Unfortunately, people that are already retired, you can't go back in time and create those. But if you're still working, take advantage of it. You may or may not want to use it early because you may want to take advantage of those compounding attributes in a tax-free environment that the HSA provides.
Jeff, great conversation here. I want to talk to our listeners for just a moment. If you're thinking about retirement, right now is the time to take control of your future. Don't leave it to chance. Call 520-780-9059 right now and get your Premier Retirement Roadmap, no cost and no obligation. This is more than just a guide. It's a personalized blueprint to help you grow your savings, protect your nest egg, and create multiple streams of income so you never have to worry about running out of money. We'll show you the smart moves the wealthy use to enjoy retirement with freedom, security, and peace of mind. And you can start today. Pick up the phone right now and call 520-780-9059 and claim your Premier Retirement Roadmap. Again, no cost and no obligation. Take the first step towards the retirement you've dreamed of, one you can control and truly deserve. It's 520-780-9059, and you can make that call right now. You can also visit us online and request your Premier Retirement Roadmap at premret.com. That's PREMRET.com. Jeff, time for a break. When we come back, we've got listener questions and more when Premier Retirement continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shea.
Thanks so much for making us a part of your weekend. You're listening to Premier Retirement with Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Reminder for you, we're on the air for you 4 times a week, Saturdays at 7 a.m., 9 a.m., and 1 p.m., and also Sundays at 11 a.m. And if those are not convenient, we're also a podcast. Go to wherever you get your podcasts, search for Premier Retirement with Jeff Vogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. Once again, 520-780-9059 is our telephone number, 520-780-9059. You hear anything that you'd like to talk further about with Jeff, you can get that. It's called the Premier Retirement Roadmap, and no cost and no obligation for that. Okay, Jeff, time for listener questions. Tom's listening to us in Tucson. Tom says, my mother recently passed, and the company carrying her annuity has sent paperwork to us beneficiaries. One option is to create a non-qualified stretch annuity. I'm trying to learn about this, but starting from ground zero. I don't need the money now, and I want to minimize the tax hit. Our yearly income is around $300,000 if that matters. This sounds like a pretty good option, but one question is, can it also be inherited by my child if it's not depleted by mandatory withdrawals? What are your thoughts?
Well, it sounds like, okay, first of all, a stretch IRA is not available anymore for IRAs, and you said it was non-qualified. And then you mentioned that there's depleted mandatory withdrawals. There are no required minimum withdrawals like an IRA, But depending on the structure, and I don't know the details of how they want to stretch this annuity out, every company has kind of a different rule. Some won't do it. Some will say, 5-year payout's the max you can do. Some say, well, it's either lump sum or you can annuitize for your life. Generally speaking, in that case, the stretch IRA is in non-qualified funds typically are not generation skipping unless they're in some sort of a trust that allows it to be. The thing is any type of a stretch annuity would have to be based on the life expectancy or the lifetime of the child or whoever's going to inherit it, you being the children, and the grandchildren may or may not be there. The only way that I would say, and unfortunately on an inherited IRA, I don't know how much is in there. I don't know what kind of a tax hit you'll take. If it's $100,000, might be smart to just, you're at $300,000 income. If you took it right now, you'd pay 24% federal tax on it, and you'd be done paying the tax. You could reinvest it in whatever you wanted to. The annuity, I am guessing, probably has like a 1 or a 2% internal rate of return. So I don't know why you'd want to make 1 or 2% for the rest of your life just to save a little bit of tax, because you'll end up paying tax on that little bit anyway, probably at a 22% bracket. If you're making $300,000 now, you're probably going to stay in a pretty decent tax bracket during retirement. I don't know that stretching out those taxes are going to be a benefit to you. I kind of doubt they would be. But taking a lump sum right now is also not good. If it's $1 million in that IRA, now you go into a 40% combined tax bracket, and you don't want to do that. So if there is a stretch or if there is a certain thing, I'm guessing though, if it's a non-qualified, you're going to have to start taking some money out immediately, depending on what their terms are, how many years they would stretch it out. If you could do a 20-year period certain stretch or something like that, then you'd have less income up front, but you'd at least have some money going for the next 20 years. And if it's a period certain, then yes, the balance of those payments would pass on to your children. If it's just a 5-year certain and life, then you get 5 years, you die in year 6, it's done. There is no benefit because you live past a certain period. So the stretch IRA based on just life expectancy paid out over, I'd like to see the terms of it. If it's just an annuity until everybody dies, and if everybody dies early, then the insurance company might really win on that thing because they'll keep the balance of whatever the account is. But if you have a guaranteed payout of principal over a certain period of time, plus an interest rate that's reasonable, like at least above 3 or 4%, which I doubt you would get, the math would say take the tax hit now and screw the tax man by putting into something that's either tax-free or tax efficient for you for the rest of your life, or pay taxes once, don't pay taxes on the next 5 or 10 years that you're working, or I don't know, if you're making $300,000, I don't know how old you are, but your mom recently passed away, maybe in your 50s or 60s, maybe you don't have that long till retirement. Maybe you could find out if there's a plan where you can have another annuity that grows at 3% for 10 years, and you have to take it out at the end of 10 years when you'll be retired and you don't have that income tax problem. You just said one option is, and that sounded good. Well, I don't know what the other options are, and I also don't know the terms of the option you're explaining. So the non-qualified stretch annuity can come in many forms. So read the fine print. If you need somebody to go through it with you that understands annuities, understands the different options, I'd consult an advisor, probably an independent advisor like us that does annuities on a regular basis, that has been around long enough to have a lot of clients pass away and leave these things to their kids. So that makes sense. We'd love to hear from you. Happy to look at it, or find somebody that you trust that does the same type of analysis that would have a better opportunity to actually look at the details before they make a recommendation. And I certainly can't make a recommendation. I can only give you my thoughts. And I appreciate you saying, what are your thoughts? Not what are your recommendations? So you got a bunch of my thoughts. Those are some things, maybe some questions to ask yourself or to ask the company or to look for in the fine print of the contract options.
Tom, thanks for listening to us in Tucson. And of course, if you want to further this conversation, call Jeff at 520-780-9059. No cost and no obligation to do that. Okay, Jeff, next question. Dominic is in Pima Canyon. Dominic says, I inherited a large retirement account, roughly $1.7 million, from my father who passed away about 3 months ago. What are my investment and distribution options without triggering big taxes?
Dominic, that's a nice large retirement account, $1.7 million. That could set you up pretty good for retirement if you don't have your own retirement plan. But if it goes on top of your retirement plan, you might have a big tax problem, much bigger than what you thought. It also depends on, if that retirement account has a portion of it that's Roth. Maybe it does, maybe it doesn't. For people that are passing away that are much older, they kind of didn't really jump on that Roth thing as well as some of the younger people did. And maybe you've got the Roth and they don't. But that is a tax issue, obviously. Your investment distribution options are going to be, you got to take it out in the next 10 years. So if you're retired now and you don't have a very high tax bracket, maybe you haven't taken Social Security, maybe you live on some of it, try to draw it down so that it isn't a big tax problem when you're 73 or 74 when you have to start pulling that money out. Maybe you want to live on a couple $100,000 a year, pay tax on that, and then convert a couple $100,000 a year into a Roth and do it all at a 24% tax bracket or lower. and be done with taxes for the rest of your life. You might also think about converting it to not just a Roth, but you could convert it to a LIRP and get tax-free income for the rest of your life. I don't know how old you are, but let's say if you're in your early 60s, just pick a number. And let's say you converted that 1.7 million, even if you pay tax at 24%, you end up with about $1.5 million in either a Roth or maybe even a LIRP, depending on your other assets. You don't put all your money in a LIRP, but I'm assuming you have maybe a few million yourself or a million or so. Maybe you don't have anything, but we talk differently. But just to give you some context, that $1.5 million after taxes would give you probably $100,000 or more every year for the rest of your life, tax-free, and never even affect the taxes on your Social Security. It'd be kind of a nice little bump. Now, if you use the 4% rule from what the stock market says is a safe withdrawal rate on 1.7 million in an IRA, by the way, you have to pull it all out and pay taxes on it within the next 10 years. So you'd have to accelerate this. But even with the 4% rule drawdown, you're only taking 60 or 70,000 out per year forever. So you might want to just say, you know what, I have to pay tax in the next 10 years anyway. Let's just get rid of this problem now and go tax-free. Or we can say, well, based on the fact that I don't have any other assets, I can just annuitize this for $100,000 a year and I'll be in a 22% tax bracket or a 12% tax bracket for the rest of my life. Maybe that's what you want. But I would look at your overall picture before I could make any sense out of your tax problem that this would cause you or that it may not cause you. And depending on how old you are, whether you're still working or not still working, whether or not you want to do some tax planning now or wait till you retire and have a window of opportunity between the time you retire and the time you have to take required minimum distributions out or have to take your Social Security and that kind of thing. So again, I say this every week, and the answer to almost all these questions is it depends, because there's really not enough room for you to sit and I only have like 3 minutes on the voicemail. So if you're calling these in, I don't have enough room probably to hear all the details. And certainly it would probably take a nice visit to dissect this plan and what your plan would be to make a plan and to see how this inheritance fits in. But yeah, you've got a potential big tax problem, and that would be the first concern would be on my mind if I were you.
Dominic, thanks for listening to us in Pima Canyon, and of course, further that conversation with Jeff by calling 520-780-9059. Okay, Jeff, next question. Gil is in Tanque Verde. Gil says, I've accumulated about $600,000 in shares of Apple stock. This is my whole stock portfolio. I think Apple is a good company, but I'm worried that I'm not diversified enough. I'm wondering if I should sell some of the shares and put money into something else. I've had a lot of this stock for more than 25 years. Also, what is my potential tax burden?
Well, the potential tax burden, depending on how fast you sell it. I mean, the most you'd have to pay on any part of that $600,000, depending on what you paid for it. I mean, I'm guessing, is this in an IRA? If you want to sell and take profits, an IRA is the best place to take profits. And I certainly would diversify. I mean, looking at Apple shares, they're only up about 6 or 7% from a year ago. Year to date, they're down 3 or 4, kind of keeping up with the market, depending on when you buy and when you sell. And the last 2 years, they haven't even barely kept up with the market because they had a couple of good upsides. But, Apple's a company that's not going to go away. But then again, so was Enron way back in the time when it went away. So they pulled some shenanigans. I don't think Apple's in that same boat. So I don't know if paying the taxes is worth it, other than the fact that there are other companies that are doing very well. You've got other good companies. I mean, Google's done well. Some of the big, solid blue chip tech companies, I think are still good long-term plays to dollar cost average into. I think you need to just remember that anytime you take profits, it's a good thing. I don't think Apple will go down over the long haul much, but I do think that there's other opportunities out there in the market where you could be making more money over the next year or two than the taxes you pay. So let's say you diversified out of half of it and had to pay, let's say 15% taxes on $100,000 profit, depending on when you sold it and when you bought it, what your basis is going to determine your taxes. Maybe you pay $30,000 or $40,000 or $50,000 in taxes, but you reinvest that $200,000 or $300,000 of Apple stock into something that goes up 20 or 30%. I mean, our diversified portfolio in our growth section, I should probably brag about it, but we doubled the market last year. So, and we probably tripled what Apple made, actually more than quadrupled it. But I mean, there are ways to make money that aren't Apple. And if you're willing to either hire an advisor that watches the market and can make those changes for you, or if you just are hell-bent on Apple because that's just your thing, then you're going to live and die on the sentimental value of that Apple stock. And there's stocks that I think I'd be more scared of owning at their all-time high than Apple. But at the same time, you never know. I mean, there's a lot of other phone companies that are coming around and making technology advances that are starting to compete with Apple. So, are they going to be that king of the universe in the phone space or the eye space or not? I don't know. Fact is you never get hurt taking a profit. I guess that's probably the best thing I can say. And diversification is not a bad thing. But here's the deal. The IRS is your partner forever. I mean, they're your partner. You married them when you said, I'm going to buy something, and if I make money, I owe you something. So, I mean, you can either cut it off and basically divorce your partner on some of those shares and say, okay, now you're not my partner. But then, of course, if you're going to buy something else, you're going to get remarried. I'm mixed on that. I'm a big fan of diversification. I'm also a big fan of not having all your eggs in one basket. And I don't know if this is all your eggs, but if it is all your eggs, then yeah, I'd probably definitely start shrinking your holdings and redeploy them into things that either had long-term growth, or if you're getting close to retirement, maybe something that you can get in and create some income from. Maybe you need $2,000-$3,000 a month in income and you don't want to keep selling Apple on the ups and downs. Well, maybe you just put half of that Apple money into something that'll buy you a nice little income supplement during your retirement. And you let that $300,000 of Apple ride and let it grow to $600,000 again. And every time it grows to $600,000, you take half of it off the table and buy some income or put it someplace safe. That's just one strategy that comes to mind, but there's tons of ways to skin the cat. I don't know what your overall goals are. I don't know how old you are. I don't know when you're going to retire. If you need that $600,000 to live on, if that's what you've stored away for retirement, if that's the case, then definitely you probably need to rethink, how you structure that, because you shouldn't bet retirement or income on one thing, even if it's one good stock. So keep that in mind. Hope that helps. And your potential tax burden at max would be 15 to 20%, depending on how much of it you sold, but just the gains. And of course, depending on when you bought it, when you sold it, that's going to dictate what your profits are.
Gil, great question. Thanks for listening to us in Tanque Verde. And once again, if you'd like to further the conversation with Jeff, 520-780-9059 is the number. And if you've got a question you'd like us to answer on the air, you can get it to us by calling that in, 520-780-9059. You can also go to the website, primret.com, and get it to us there. If we use your question on the air, you'll get a great answer and Jeff's book, Retirement, The Road Ahead. Listening to Premier Retirement with Jeff Vogan. Once again, if you would like your Premier Retirement Roadmap, no cost, no obligation, it is the same number, 520-780-9059, primret.com. We would love to help you out. Okay, Jeff, let's talk about our last subject here, and this is the LIRP, the retirement solution, or just one tool. So let's start with the basics, Jeff. What exactly is a LIRP, and why do some people think it is so powerful?
Well, they probably think it's so powerful because I tell them it's powerful, or because when they see it on paper and see the math of how it works and understand how it works, they realize that it's pretty flexible. It's stealth. It never generates a 1099 and becomes a taxable event unless you use it wrong. And some people have heard of a guy named David McKnight. He wrote a book called Power of Zero. That kind of got it all started, where he said, how can we create a zero tax environment in retirement? And it was all about converting to Roth at first, but you can't convert all your money to a Roth. You might have other assets. How about convert it to LIRPs, life insurance, which gives you predictable income, tax-free income. Annuities you can do in Roth gives you guaranteed income. So balancing those two out, you could actually divest all your taxable and future tax problems into a plan where you live tax-free. Now, it may cost you more in the early stages to do that, but you have to let the math, and we have a spreadsheet that, and actually some Roth conversion tools that will actually show us exactly what we save by doing it now compared to if we do it later. Of course, we have to assume either current tax brackets or assumed future tax brackets, and you can change those around based on your own assumptions, own belief system, and retirement plan, giving your whole picture. But LIRPs are great. When you look at who owns LIRPs, generally speaking, is wealthy people that are in a high tax bracket. They do it as a stealth or a tax savings program, as a way to keep money kind of out of the eyes of the IRS, so they can, have a place they can always go grab money for business investments, for cars, for trips, for college, for all kinds of things that they might spend money on without having to tap into an account where they would have to pay taxes, like, for example, sell company stock and pay 20% tax on capital gains, or take money out of their business and, have to call it income, and they're in a 40% tax bracket. They don't want to do that. So if you have this big tax-free bank account, essentially, where you put millions of dollars into it, and of course, the typical retiree we deal with doesn't have millions and millions of dollars in it. We have many clients that have more than $1 million into LIRPs, but it's how much of your assets do you want to put away in a tax-free bank account, basically, and rather than withdraw from that bank account, you just get a loan against it. So let's just say you have a bank account, and just use it in terms of a bank account. If you had a bank account where you had CDs paying 6%, and you could go in there anytime and withdraw that money and no longer make the 6%, or you could go in there and say, hey, I want to borrow money, keep the 6% going, but can I borrow some money? And they loan it to you at 5%. Oh, and guess what? If that CD, well, I don't like the idea of CD because every year they're going to give you 1099 on the interest you made anyway, but let's just say it was a tax-deferred annuity or something like that. You pull the money out, you have to pay taxes on whatever you gain. But if you borrow money, you don't have to pay taxes on anything because it's just a loan against that future growth. And if it's growing in a tax-free environment, you don't even get a 1099 for the growth every year. It just continues to compound inside that account over and over again. So as it grows and as it compounds, you're able to borrow more and more of it. I had a client that did a LIRP with about a third of his assets in retirement. I use that example in some of my seminars and meetings because it's kind of the typical way we plan. And they had a little over $100,000 that they had planned to take out. They did it for the first couple of years and they thought, well, this is extra money. We don't really know how to spend this. And so for a few years, they didn't take any money out and they want to borrow $300,000 or $400,000, buy a condo in the mountains. They go, well, we're looking at condos, but we don't really want to cash in any of our investments because we like where they're at. We're doing really well in the market right now. We've got these annuities that are safe, but if we pull money out of our IRAs, it's going to be taxable. We want to buy this cabin. It's going to be about $400,000 or $500,000. It's a nice little place in the mountains. Can we borrow from our LIRP? Well, absolutely. He goes, well, what's the tax ramification of that? I go, nothing. You borrow at 0%. In fact, you continue to make roughly 6 on average. They've actually made a little bit more than that average since they've been in it almost 10 years now. But, they borrow at a rate that is less than what they've averaged in income per year over the time they've had it. So they're continuing to grow that asset. They're going to borrow money. And not only do they borrow money and have the cabin, but they get paid on the money they use to borrow the cabin. They actually net about 1% or so. Yeah, LIRPs are awesome. That's kind of like your tax-free bank. You can use it anytime. You can use it instead of going to the bank and borrowing money and paying them to borrow their money. You can borrow your own money that you set aside if you have extra. Now, some people aren't in a position where they have a whole lot of extra. Some people are a little bit tighter on the vest and they really need that money on a regular basis. But maybe they're in a position where if they use LIRP withdrawals, they can maintain themselves in a 12% tax bracket instead of going into a 22 or a 24% bracket, especially when they have to take those required minimum distributions out when they're in their 70s, 80s, and 90s, and so forth. So great tax planning tool. It's so flexible that it makes everything else work. In fact, because of the flexibility, it can be kind of like that gap filler. When you don't make enough in the stock market to feel comfortable about pulling money out, then you can just borrow a little bit from your LIRP and it's tax-free. If you want to buy something and you don't want to pay the car dealer 8% to borrow money for a new car, just borrow from your LIRP and it still grows and you still make money on the money you spend on the car. So it might be a little bit hard to wrap your head around it just hearing it on the radio, but if you see it in action, if you see it on an illustration, if you see it on a spreadsheet and see how it works, I think you'll be more open to including it in a retirement plan. Now, there is one caveat, and that is in order to get a LIRP, because it's life insurance based, you have to be healthy enough to qualify for underwriting. You have to be relatively healthy. You can't have just gotten off a cancer treatment or on kidney dialysis. You can't have severe diabetes, that kind of thing, because your life expectancy obviously is shortened. And what they're doing is betting that they can grow your money for a long period of time while you stay alive. So I do have some older clients that actually have used their children as the person they put the life insurance on. And the cost of life insurance is actually lower on a child, but they can still use it as a benefit where they can borrow from it. And if they die, then the child just inherits that same account, and then they can leave it to their beneficiaries when they eventually pass away. But nevertheless, it still creates a tax-free account that they can withdraw from and not have a 1099 or any tax ramifications from it.
Jeff, if listeners want to take away just one thing about LIRPs, what would that be?
Well, I think what it would be is open your mind and consider whether or not it makes sense in your portfolio. If you have a tax problem, you ought to look at it. You ought to consider it right alongside of your Roth conversion strategies. Now, there are some misconceptions sometimes when we try to compare them to a fixed index annuity. They're structured slightly different. Fixed index annuities do have guaranteed income. The income off of a LIRP isn't guaranteed, but it's sometimes more, but it is tax-free and it's just structured differently. So we have to use LIRPs with a little bit of flexibility in mind. However, very often they outperform what even we think they can do. And I think many people have kind of a misconception that life insurance is something that you need in retirement. You don't really need it, but if you consider the tax savings and the flexibility of it and the fact that it doesn't cause taxes on other things like your IRMA, the Medicare premiums that you pay would go up with higher income. Income you take out of a LIRP does not count towards that. It may also be off your tax returns to where you pay less taxes on the Social Security that you bring home. And also those benefits of that extra $6,000 per spouse deduction on your taxes based on your Social Security is income based. So if you have LIRP income, it doesn't disqualify you from those other benefits that the big, beautiful tax bill has created for you. So again, I think the main thing to take away about LIRPs is not an end all, but it is a tool to enhance what you're already doing and to fill gaps for income at those higher tax bracket levels. It's a powerful retirement tool. Just one piece of the big plan. It's not an end all, but the right approach is to just evaluate, see if it's right for you and see if it fits your goals, time horizon, and how it integrates into your existing retirement accounts and income plan.
Very good conversation about LIRPs, Jeff, and I want to talk to our listeners here for just a moment. If you want to see whether or not a LIRP can fit into your retirement strategy, how it might work alongside your 401k, your IRA, or other investments, call Jeff Vogan here at 520-780-9059 and request your Premier Retirement Roadmap at no cost, showing you a personalized strategy to protect your income, manage taxes, and grow your nest egg. Don't wait. The right move right now can make a huge difference in your financial future. And again, a LIRP might be an integral part of your retirement plan. If you want to find out more, once again, it's 520-780-9059. You could also find out more about us online at premret.com. That's PREMRET.com. Jeff, we're out of time for this week. I want to thank you for your time, but most importantly, I want to thank our great listeners here in the greater Tucson area for joining us. So for Jeff Vogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.